Continuation of Chapter 12, Partnership. I want to cover the learning objectives 5 and 6, how withdrawal of a partner is accounted for, and how a partnership liquidation accounting is done. But before I do, I want to go back to allocation of profits and losses to a more complex formulation. Previously, we talked about sharing profits by some ratio only. 2 partners, 50-50. 3 partners equal 1-1-1, or some other ratio that all profit is allocated on. This would be a simple allocation of profits. I want to look at a complex one that your chapter discusses: allocation or distribution of profits based on a combination of services, capital balances of the prior year, and a stated ratio. So all 3 methods incorporated into a layered formula of distribution of profit for the year to the partners. We'll see that we'll look at a formula that has a salary allowance to begin with. Secondly, the next allocation based on partners' capital balance, prior year balance, and then finally some ratio, in this case evenly, of the amount that remains. The chapter shows a distribution of profits for the year using this layered or complex distribution formula. Again, 3 different ways or 3 different formulas to go through to allocate one amount. The net income for the year for the partnership is $60,000. We're going to allocate that first by giving a salary allowance to each partner. In this case, there's 2 partners as shown, and then a allocation of the net income based on prior year's balances, 10% of prior year's capital balance. This type of formulation gives an incentive for a partner to let his capital stay in the business. So the more capital that stays in his business, and this is part of the formulation for current year distribution of profits, this will give him a higher distribution if he has a higher capital balance. And finally, a ratio allocation of the remainder. So what we're doing here is we're allocating $60,000 to 2 partners in a layered distribution using 3 formulas. All 3 formulas. So the first formula is partner Bright gets a salary allowance as negotiated of $16,000 per year. Gonzalez gets a salary allowance of $24,000 per year. Secondly, there's an allocation. We're subtracting it from this amount here. Secondly, there's an allocation based on the prior year's capital balances. 10% of the prior year, Bright had a capital balance of $30,000, so he gets a $3,000 allocation of the current year out of this profit. Gonzalez had a $20,000 a lower capital balance as of last year. He gets $2,000 out of the current year of this distribution. So, of the salary allowance to Bright and the allocation based on last year's capital, the salary allowance to Gonzalez, last year's capital balance, we totaled $45,000 so far. So $60,000 less $45,000 leaves $15,000 balance to be distributed. And how are we going to do that? 50-50. So the $15,000, Bright gets half and Gonzalez gets half. Add them all up, $26,000 plus $33,000 equals $60,000 distributed. So this column has simply detailed the declining balance of this based on the formula. $60,000 profit net income for the year between the salary allowances given to each partner based on probably the level of service they gave to the partnership. Gonzalez giving a higher level of service based on 10% of their prior capital balance. Those two totaled $45,000, remaining $15,000. That remainder split 50-50. So 60 less 45 less 15 is 0. We've distributed it all. And the proof is Bright got $26,500, Gonzalez got $33,500, total of $60,000 was distributed for the year. Now, one comment about a layered distribution like this: if there is any salary allowance given to partners, this salary allowance is not an expense that determines net income. Any salary allowance given to partners does not reduce or determine net income. It's simply a distribution of that net income. In other words, this is not a salary expense we'd see in a normal business that reduces net income. So the net income that's shown for the partnership is before any salary allowances. Again, those salary allowances don't determine net income. They're a distribution of some portion of net income according to a set formula. This set formula: $16,000 a year to Bright, $24,000 a year to Gonzalez. So a complicated multi-factor allocation of net income. The same would go for if there was a loss for the year. The next page in the book shows a loss for the year. We're going to allocate it in a similar fashion. They still get their salary allowances. They still get their allowances based on the capital balance of the previous year. So those total $1926, again, $45,000. But now that $45,000 distribution formula adds to the net loss, and so we have a net loss of $63,000 left, split 50-50. So again, all of the loss is distributed, $18,000, $12,500 to Bright, $5,500 to Gonzalez. Those two losses total $18,000 negative. Again, if it's a net loss that's being distributed, we still go through the formulas in a positive way of what they would have gotten in a normal year in terms of any salary allowance, capital allocation, but then that increases the amount of the negative or loss that's distributed 50-50 in this case to each partner. Again, partnership net income is distributed however the partners agree. Normally this would be detailed in a partnership agreement. And we've gone through a very complicated formula using 3 factors, a layered formula applied in sequence to distribute the partnership net income for the year to the 2 partners. Okay, now let's examine how a partner withdrawal is accounted for in a partnership. A partner leaving the partnership. First of all, the existing partnership is dissolved and a new partnership agreement has to be written up for the remaining partners. A partner withdrawal can be handled one of 2 ways. Either the withdrawing partner sells his interest to another party. In other words, that transaction is an exchange outside the partnership. It does not involve distribution of the partnership assets. All it requires is approval of admission of that new partner to the partnership. So, selling interest to another, cash exchange between the withdrawing partner and a new partner coming in, does not affect the assets of the partnership. Very simple entry on the books. Similar to a new partner coming in, by the way, and buying it. This is just the flip-flop of it. The interest is sold to another. We simply have to remove the old partner's capital with a debit. Capital balance are normally credit balance in the books, and recognize a new partner coming in. Simply a swap on the capital accounts by selling an interest to another. Any cash exchange between these 2 partners is done by their own agreement, does not involve the assets of the partnership. The second method to account for a partner withdrawal, withdrawing partnership assets in settlement of the partner leaving. This is more complex. and is very similar to a new partner coming in terms of the scenarios. The withdrawing partner, either the assets are withdrawn at the book value of the capital account of the withdrawing partner, or below the book value of the capital balance of the withdrawing partner, or above the book value of the capital balance of the withdrawing partner. The only question is, how much cash is going to be distributed? Equal to the capital value of the withdrawing partner, below it, or above it. These three scenarios, though, exactly correspond to what we saw new partners coming in a previous talk. Either they come in and they pay the negotiated price is what they get for their investment, or the new partner gets below his negotiated amount and pays a bonus to existing partners, or the new partner himself gets a bonus because it's above his negotiated amount. He gets more than the value contributed, and it comes from the other partners. So this mirrors, the withdrawing things mirror that exactly. Again, the key question, withdrawal of assets by withdrawing partner, at what value? So looking at the accounting for this scenario, assets are withdrawn to sell the partner that's leaving, and so there's going to be a debit to that partner's account, removing the book value, and the only question is, how much cash does that partner get paid? Does he get paid book value? Does he get paid below book value of his capital account? Or does he get paid above book value of that capital account? Once that's determined, the true-up entry is to the other partners. Let's take a scenario where the book value is removed $100,000 and the partner is paid at book value, $100,000, end of entry. He's paid exactly book value. Let's say he's paid more than book value, paid $120,000. Now we need another debit over here to the existing, or the remaining partners' accounts, because they've agreed to pay more than book value. So they have to give up some of theirs to ensure the entry balances. If the partner is paid less than book value, $80,000, in effect, the existing partners are credited because the withdrawing partner wants to get out of the partnership. He agrees to take less than his book value, and the difference gets credited to the remaining partners. So it's all about determining how much cash is distributed. Three scenarios. So that's the key determinant. The rest are mechanical entries to the partners' capital accounts. Lastly, let's cover learning objective 6, accounting for liquidation of a partnership. What is a partnership liquidation? It's shutting down all operations. So, 3 steps. We're going to sell all assets. Any gain or loss incurred on selling all those assets must be distributed to each of the partners according to their profit sharing ratio formula. Secondly, pay all legal liabilities. And lastly, pay off all partners based on the remaining capital balances. Not their profit and loss sharing ratios, but whatever is remaining. The overall objective of all these 3 series of entries is that all accounts of the books are zeroed out, because we're shutting down operations, we're closing the books, getting assets off the books, getting liabilities off the books, and then paying off the partners' capital balances. This key step here, if there's any gain or loss on the sale of non-cash assets, that must be distributed to the partners to ensure that the last operation, the payoff, exactly equals the remaining capital balances in each of the partners' accounts. Let's look at that liquidation of the Bright, Gonzalez, and Casca partnership and use this as our starting point. At the point of liquidation, just before liquidation, the partnership has $10,000 of cash, $90,000 of non-cash assets, total assets $100,000, legal liabilities of $30,000 in accounts payable, and respective owners' capital balances are $40,000, $20,000, $10,000 respectively, total of $70,000 in capital balances, plus $30,000 liability, total liabilities in capital $100,000. So, the three steps. First, sell all non-cash assets. So the company is going to sell its $90,000 of non-cash assets. If it sells that book value, this is reduced to zero and cash is increased to $100,000. The example in your book assumes that first this is sold above book value. So if it's sold above book value, we're going to end up increasing the value of the partners' accounts. So again, the beginning balances, cash, non-cash assets, accounts payable, and partnership credit balances to the capital accounts. First thing, sell the non-cash assets. We're going to assume that we sold them for $150,000. That's kind of unusual. This exaggerates the gain. But so we sell it, these non-cash assets, for $150,000 cash. We take the book value of the non-cash assets out, zeroed out, we sold them, and we have a $60,000 gain, and that gain must be distributed to each partner in the ratio of their profit and loss sharing ratios. In this case, it increases it. So, secondly, pay all legal liabilities. $30,000 of legal liabilities, those are paid off, reduced to zero. Cash is reduced in paying it off. And the remaining balances, $130,000 of cash remaining, and three capital balances which total that $130,000. So each of these partners gets exactly what remains in their capital balance in this example. Looking at the journal entries in the textbook for that, non-cash assets are sold, $90,000 non-cash assets, they come off the books with a credit. Cash is received, $150,000. There is a gain of $60,000 on the sale of those assets. Secondly, that gain is distributed, zeroed out, and each of the partners gets their share of it. $10,000 to Bright, $20,000 to Gonzalez, and Casca, $30,000. They've used a 1 to 2 to 3, that's their normal profit sharing ratio. 1/6 of this goes to Bright, 2/6 to Gonzalez, 3/6 or half of it goes to Casca. This journal entry zeroes out the gain on disposal account. Accounts payable are paid off. Credit balance is reduced by a debit. Cash goes out, reduced. What remains then is the capital balances shown as indicated, which equal exactly the remaining cash. So then a check is cut to each partner. Bright gets $50,000, reduces his capital balance to zero. Gonzalez gets $40,000, reducing his balance, and Casca gets $40,000. So cash goes out with a credit, and these accounts here are debited to reduce them. The final result, all book balances in the partnership are reduced to zero. The partnership is liquidated, it is shut down, all partners are paid off. Now there's a variation of this liquidation in your chapter where the non-cash assets are sold for a loss. Instead of getting $90,000, they get only $60,000. They come out to zero it out, but that $30,000 loss is distributed. In this case, it puts one of the partners into a deficit position after that loss is distributed. So there's a debit entry made to each of the partners' credit balances, resulting in a deficit balance for CASCA. The legal liabilities are paid off as before, $30,000 zeroed out, cash is reduced to zero them out. But now this scenario, one of the owners has a deficit balance, a debit balance. Credit, credit, debit. And so in this case, partnership agreements will generally call for the partner with the deficit balance to pay that off to the partnership. So the partnership gets cash from that deficit balance partner in order to zero out their account. To overcome that debit balance, they have to credit their account and give cash to the partnership. Now the remaining partners share the cash as per normal, zeroing out all balances. Again, an example of a sale of non-cash assets resulting in a loss, not a gain, which pushes one of the balances, credit balance, into a debit balance or deficit position. That partner has to pay that balance off to get out of the partnership. What happens if that partnership can't or refuses to pay that off? Well, then the other partners have to absorb this loss or this deficit balance between the two on the remaining partnership profit and loss sharing ratio. If this partner does not pay the partnership to zero out their deficit balance account.